So I've titled my talk today, Can the Fed Outrun Debt Deflation Without Destroying the Dollar? The idea here is that the enormous amount of debt that the West has taken on is starting to strangle our ability to grow and to be prosperous. And some academic studies that I'll show you here that sort of really make that case. Also, I like to bring out this book, The Fourth Turning. I don't know if any of you have read it, but it's, I think, one that will help you see and understand that what is happening now, we are in a major turning point. The world is changing very rapidly in many different ways. About every 20 years or so is another generation. 4 generations is a turn, and I believe this is America's fourth turning. The first one being 1776, when the British were kicked out of the colonies because they wanted to be free, and they wanted to be able to worship and to have the freedom of speech. That was the big change. That was the big reason. And then a lot of things have happened since then. Of course, the second was the Civil War. The third was the World War II and the Great Depression of World War II. And now here we are. And the authors of this book, the book was written in about 1997 and predicted that the mid-2000s would be the start of the fourth turning for America. And I believe with the financial crisis of 2008 and the election of Barack Obama, a lot of things really started changing in America and in the Western world as a result, too. So we are at that turning point, and things are changing very rapidly, some of which I'll talk about. This is certainly one of the things that have changed. The monetary system was changed dramatically, not at one of those turning points, but in 1971 when we went off the gold standard, and we decided that we could print as much money as we wanted to. We could create it out of thin air. The United States could, because it had this awesome military, and it could tell everybody else they had to buy dollars. And so we did that. But the problem is, as we took on more and more debt, interest rates could not go up without the system breaking down. And so you see what's happened with Paul Volcker. I like to tell the story, 1981, Mrs. Taylor and I, our first mortgage was a 17.5% mortgage, and we were not allowed to prepay for some 4 years or 5 years, I don't remember exactly, a few years. We had to sit with that 17.5% mortgage after the rates went down. But now they cannot raise rates anymore. Rates cannot go up without breaking the system, and this is, I think, what is happening. Now, I'd like to talk a little bit about Lacey Hunt he's a retired Federal Reserve economist, and he cites a number of academic studies that I'm going to pass along to you. His belief is that the system is inherently deflationary, and I believe that that is true. However, they are trying, and they have been successful in overriding that deflationary event with each cycle. So the question now, as we get to zero-bound interest rates, can it be done again? And I think we're about to find out. Either Lacey Hunt is right, and we go into a deflationary depression, the likes of which we've never seen, or it could go in the other direction. And so the question was asked of Lacey in a recent interview whether he thought there was any chance that the inflationary scenario could be the direction things head. And he said yes, if the Fed becomes not the lender of last resort, but the spender of last resort. In other words, if the Fed just starts printing money and pumping it into the system, the Fed so there's no check against the amount of money that is printed at all whatsoever. And so they're just almost like a hyperinflationary helicopter drop, just raining money over the entire country. What Lacey points out is that real per capita GDP really drops as debt goes up. And here you can see the blue line shows a 2.2% growth rate in the American economy going back to, I think, 1870 or 60, some 1870s after the Civil War. And then you can see what happens as we get to 2000 and 2008, and then again with COVID. The massive amounts of debt that's put in there, that was pumped into the system, has retarded our ability to grow. And so something like the per capita GDP, if it had remained on the growth curve, would be about some $20,000 higher than it is currently. So the debt is retarding our ability to grow. There's a mistake in this slide I just saw before I come down here. Total debt to GDP is something like, I can't read the numbers exactly, 300 and some percent. What I meant to put there was government debt to GDP. Total debt to GDP is very important as well. But it is, most of the things we're going to talk about here have to do, the academic studies have to do with government debt to GDP. So there's some real differences now between then, back in, we were going to look at 1979 because a lot of people think that this should be a stagflationary environment like 1979. Lacey Hunt says no, and there's some reasons for that. Again, the debt to GDP, if you look at the column or if you can read the numbers, was something like 32%, and now we're at 119%. 114 over the last 5 years, but closer to 130% now, U.S. debt to GDP. And that's grown just dramatically compared to just a few years ago when it was in 30% of debt to GDP. We had also, we were seeing now, and there'll be a slide I'll show you in a minute, that shows the velocity of money. The money is not turning over as it was then. And we had low interest rates. We have very low interest rates now, whereas in 1979, as I just mentioned, we had very high interest rates. And what that means, and when you have low interest rates, is lenders cannot price in risk. They can't price risk. If you've got 2% on the 10-year, how are you going to price in risk, especially if inflation is running where it is now? So these are some of the major differences between now and 1979. So the debt overhang growth, it really has showed that this was 26 different historical, 26 studies in 22 advanced nations. And it showed that when debt grows over 90%, you start to see a really dramatic decline in income and in the growth of the economy. An interesting aspect of this study from very well-known economists, Rogoff and Reinhardt, was that interest rates don't rise even when you get over 90% of debt to GDP, even if there's a tight monetary policy. And I would say that that's because the system cannot take higher rates. It just simply cannot. So this study was also followed up over the last number of years, so there's a lot of peer reviews, or there are a lot of other studies subsequently. This slide just shows what happens as debt grows. All of these, the U.S., the Eurozone, as well as Japan, have had increasing debt loads. Japan, the greatest, the Euro, second greatest, and the U.S., the third greatest. But you can see the trend, and this is really, this is the growth of debt. This is the growth of GDP as debt grows. That is the incremental growth with another dollar of debt that's put in the system. This shows the diminishing returns. Another debt added as debt piles up in the system. Fewer, it's just less potent. So we've gone from something like, if I can read the numbers, something like 62 cents for every dollar of debt going back early in our history, and now it's down to 25 cents of every dollar that's put into the system. And it's worse for the other two countries, that are three countries, because China's shown there as well, I believe. So the countries with higher debt are even lower than that. So it becomes impotent. The Fed's ability to stimulate the growth of the economy with monetary policy becomes really not capable of growing it very much at all. As a matter of fact, it becomes very negative. So another study was done, showed a 10% increase in government spending ends up decreasing GDP by 0.5% to 1%. This was done by some Swedish economists. Under low government debt to GDP, less than 40%, you can get more of a result from pumping money in the system. But government spending, as it grows, as it gets to 60% or so, it really starts to bite. And if you get over 90%, it really becomes negative. The multiplier becomes negative. That is, the money that goes in the system, the banks will lend less and less out to into the economy, so the economy can't grow. This slide just simply shows the money multiplier, and you can see how it's fallen off the cliff in 2008. And the money multiplier, it's a monetary base plus the multiplier. When banks lend, the idea is the banks lend to one bank, and the bank takes that money and lends, and it ripples through the system. So the Keynesian idea was that the government, you could just pump money into the system from the government or the banks, and it would flow through the system and grow the economy. The problem with that is that where the central banks have control of the monetary base, they don't have control of the multiplier, because that's a function of the markets, and they can't really do anything about that. And then velocity of money, how fast money turns over. Well, it's just plunging, just like the multiplier. It's plunging. And I would suggest that's partly because the debt is so high that the debt is eating up disposable income. And then again, there's that idea with lower interest rates. As you take on more and more debt, the interest rates have to keep getting lower, that there's not risk pricing available for the lenders. And so loans don't get made, and the economies cannot grow. This is just showing marginal revenue as debt grows, and marginal revenue, and again, velocity, it's falling off the table. This is the M2, the measure of money velocity, and it shows the different countries, the US, Eurozone, Japan, and China, and the countries with the biggest debts are having the lowest velocity, M2 velocity. So the idea is that debt is really just strangling the growth potential of a country. It's like what we've done is we've lived high for now and we pulled forward demand into the present at the expense of the future. And now the future, I think, is here, and we're starting to really feel it. Another very interesting study by a couple of academics, one from, I think, University of Chicago, maybe the other one from Harvard. I can't read it, and I can't remember exactly, but the impact of quantitative easing on and tapering on the stock prices, and they found that there was elasticity of demand of something like 0.2, which meant that new money that went into the system, people couldn't find very much to do with it other than to buy stocks. So as the new money went into the stocks, and it rippled through the system, $1 of QE would add $5 in stock prices. It doesn't mean that they were worth 5 times more, it just means that they were priced up. And the opposite is true when you start to pull money out, when you taper. And I think that's probably this taper talk. We're seeing what's happening now in the equity markets for sure. So to me, it's like it's an issue of living beyond our means for the longest time. Now the issue is why then, the 1970s, we were able to we had inflation and we had growth. Well, we had some deflation, we had some stagnation. It was stagnant. It was a fairly stagnant economy at times, but the prices rose, and the output of GDP didn't fall off the table. Well, this chart, of course, the price is on the vertical axis, and GDP is on the horizontal axis. You have the upward sloping supply curves and the downward sloping demand curves. You see, you can't read the numbers now, but the upward supply curve in 1970, it shifted higher or inward, which meant that there was a shortage of supply due to the oil shortages, the oil embargoes, and so forth. So we had the supply shortage issue, similar to what we had with COVID. But at that time, we had very low debt, 33% debt to GDP. We had velocity was stable. It wasn't falling off the cliff like it is now. Interest rates were very high, as I said. All those things meant that that money put into the system could expand demand. So you see that downward sloping demand curve shifted up. That was why, according to Lacey Hunt, his theory, why we could get stagflation in the 1970s. He doesn't believe we're going to get it now, even though we have we do have high inflation rates now. So why do we have it now? Well, he simply explains the supply chain issues, which has limited supply and therefore has shifted the supply curve inward, which means that prices have gone up because there's less supply. However, unlike the 1970s, Lacey Hunt maintains that we're not seeing any kind of permanent growth in the demand curve. So he leaves the demand curve, the downward sloping curve, as it is. And again, that's because of the massive amounts of debt, the velocity that is so incredibly high, the velocity has fallen off a cliff, and you have these incredibly low interest rates. So banks aren't making loans. The only place the money can go is into the stock market, or when it flows back out, it's going into treasuries, maybe into gold a little bit, and maybe a little bit into Bitcoin, although that's yet to be seen. Now, David Stockman was recently on my show, and I'm going to just play what he had to say about Lacey Hunt's interview that I'm prefacing here and basing my talk on was a couple of weeks before the war in the Ukraine. But this is what David had to say about the supply chain issues in the United States the United States policy.
In response, these brilliant people in Washington have said, yeah, we know how to fix this. We'll attack the entire global economy and financial system with sanctions and exclusions and, shutting down access to the SWIFT system and all the rest of it. And that'll teach the Russians a lesson. That is crazy as hell. That is going to wreck the trading system of the world, which is actually designed for a peaceful world order. Mm-hmm. It is not designed for a time of warfare, and we're seeing examples of it every day. For instance, we've had this tremendous semiconductor shortage, which we all know is the cause of many of these bottlenecks that we've been having in every kind of industry, including auto. And we find out today that a key ingredient that goes into semiconductor production is actually made, neon gas is made almost exclusively in the Ukraine, including in fact, the factory is located in the Donbass in the eastern side, and it's shut down. Now, that's one thing. Another I saw yesterday, there was some desperate guy on Bubble Vision who was, in the international transportation business, telling people that most of the goods which go to Europe from China, and we're talking here hundreds of billions of consumer goods a year, transit through Russia by rail. And all of a sudden, the owners of those goods are not wanting to get caught with their Russian pants down by the sanctions, and so they're desperately attempting to reroute their shipments either by sea or by air. And as a result, almost overnight, prices for ocean freight have increased 3 to 5 times on top of the huge eruption that occurred during the COVID era. Yeah. So to make it simple, it's going to cost about $40,000 to move goods in one container from China to Europe, compared to $2,000 pre-COVID 2019, before all of these different disasters descended on the system. Yeah. So somehow, if they think they're actually punishing the Russians, they're out of their minds. This is going to, the second, third, and fourth order impacts of all these sanctions and disruptions of the very intricate patterns of global trade and finance. They don't have the slightest clue of what's going to happen tomorrow, the next day, and the day after. And it's going to end up punishing the American people every bit as much as it will Russia.
All right, well, I hope David's wrong about that. But clearly already we're seeing supply chain disruptions that might very well make the COVID ones look like child's play. So just this diagram then, what I'm suggesting, the red line is a shift outward in the supply, or a reduction in supply because of these supply chain issues that are, without a doubt, whether David is overhyping it or not, the point is that there is going to be significant supply chain, and already are supply chain issues that are resulting from the war. So that would also increase the prices that we're going to pay. And I think the latest, I didn't hear the number, but I think the latest CPI was something like 7.8 or 7.9 or something like that. Anybody hear it? No? So anyway, it's the worst inflation problem we've had since I was a kid, I was actually a kid compared to now, in my early 20s and the 70s. So Alistair MacLeod, and almost out of time already, Alistair MacLeod, who's frequently on my radio show, has pointed out that with the rise of interest rates and the heavy amount of bonds and treasuries that various major central banks are owning, have now caused them to be upside down on their balance sheets. The central banks, because they own they bought these bonds at these incredibly low prices. Just the small rise up in interest rates so far are causing the Bank of England, the Bank of Japan, and the U.S. Bank to be essentially negative net worth entities. And so there's a quote from David I'm not going to read, and I can hardly read it anyway with my old eyes, so I'll skip over that, but it's worth reading if you can read it. He's basically saying that the elites that basically more and more control our economies. You talk about fourth turning, I think that's one of them. It is a very small number of people who are making policy in major Western countries now, and they are taking care of themselves, and they're going to make sure that whatever has to happen monetarily, it's going to happen. Just real quickly, this was again with Lacey Hunt, saying, well, yes, he says, well, yes, we could actually have a real inflationary problem if the Fed becomes the spender and not the lender of last resort. And Lynn Alden, who I also have on my show from time to time, had this diagram of monetary theory, the monetary, what's it called, modern monetary theory, essentially getting rid of the Fed, getting rid of all these structures that get in the way of letting people see what's going on. So behind the curtain, the idea is that they're going to print, they're going to do whatever they need to take care of the people that are of the elite. So I don't know which way this is going to go. I think it could go. I really believe that we have a problem that. So the question is, can the currency survive if this happens? Or are we going to have a reset, which I think is increasingly likely, some kind of a reset, a monetary reset. How it's going to take shape, I don't know. On the deflation side, if Lacey Hunt is right and we have a significant deflation, anything like the 1930s, bear in mind it was the best of times for gold miners, the producers. They did it incredibly well. Home stake went up. Well, you can see the yellow line was home stake. The blue line was the Dow Jones. And so people who own gold and gold shares fared very well at that time. Bitcoin, I don't know, this is a little outdated, about a week old. It wasn't performing very well. I haven't checked the last day or two. So that's the question. Gold is clearly, this is a monthly chart. I take an average price per month and plot it going back to 1995 here. Clearly the chart is very constructive and very bullish. So, this is a time when I think, it's a very disconcerting time. It's very difficult. But I do think that if there's anything I do believe is true, is that gold is money. It has been money forever. And there's a reason why gold is behaving the way it is. There's a reason why some central banks, especially those that are opposed to the United States, are really loading up and have been loading up on gold for many, many years, because they know that that's wealth that cannot be destroyed like money can be destroyed. Well, fiat money, I should say. That's all I have to say about the current state of affairs. It's trying, and I guess we need to hang in there as best we can, and probably give some trust to our Creator and hope for the best, because things are looking very unnerving.